This is the episode for those that already been at gas station and bragging around about at how expensive trip they eventually been. So, joking aside, boop, boop. This is the episode for those that already been at gas station and bragging around about at how expensive trip they already been. Alright, joking aside, Friday's soaring CPI gauge has literally crushed peak inflation narrative. Right now, the market is pricing in even up to 10 more rate hikes by the end of 2022. That's why so many traders and investors are betting there's far more downside ahead. But are these assumptions right, and are there any symptoms we may have a reversal? Right now, I would like to take a look at where we might be heading next in terms of indexes and also cryptocurrencies that recently just got through a sell-off. So let's begin. Alright, and we are starting off with economy view, so let's head straight to the news. Used consumer prices reaccelerate in May, highest since 1981. Right now we have such of a picture that we may find that rises of different goods in US has really skyrocketed, and right now are heading into such territory that haven't been seen yet. Among them there is fuel oil that has risen dramatically, motor fuel, utility piped gas service, so energy costs are among them that impact the inflation the most right now. But there is a hard nut to crack for the Fed, as either inflation stays higher for longer, central banks need to do more, and that is detrimental to valuations. Right now we've seen that markets are in the vicious upper half of the central bank hike inflation cycle. So we have rate increase as investors expect Fed to be increasing hawkish. Right after there is a projection that have investors to worry about a recession fueled by higher rates, and right after equities trade down. So that's the three steps that we already been through. The next one step might be more optimistic. Investors have viewed that inflation will slow and Fed will be more dovish again. However, at first the earnings estimates might be still having to come down. Right now the revisions that already been made by Morgan Stanley consensus assumes that in 2023 those assumptions will rise, and that was a research made on 3rd of June. So it was before the CPI's gauge publication. On the same day of CPI's being published, we already had also University of Michigan Consumer Sentiment Index, and it has slumped to a record low where we had lower than 50 points, metric points. So that's why it comes down to a conclusion that these revisions should get downwards. And right now Fed is ahead of a choice whether we are going to accept higher inflation or rather bring down recession on economy. Right now there is no other option. Unfortunately, Fed by hiking interest rates don't have an kind of a power to lower commodities and other goods price down. Right now, more and more economists are getting more pessimistic about the opportunity of stabilizing inflation at an acceptable level without a recession. The possible recession and having a situation where GDP is lowering by 2 consecutive months is the scenario more and more likely and probable. In order to have earnings of the companies at a stable level, we need to have consumers to not be afraid of buying and not be such defensive as they are right now. The University of Michigan is exactly pointing out that the levels of such pessimism has recently been seen right back in 2008 and 80s. But right now, the problem we eventually been led to as coming down to a surging inflation that hasn't been seen in 2008. So those times are more likely 80s when we had also a double-digit inflation rate, and some of the speculators are claiming that these problems we are just going through in some cases are more similar to when we were at global financial crisis in 30s. So we have that still a very bad scenario intact, where we have a very low growth of the economy and also hiring prices of goods that will eventually may lead us to a stagflationary aspect. So the only thing that Fed is going to do probably is that they're gonna rate hikes even more, and that's what the market are anticipating, and they are changing their projections regarding where the Fed's policy might finally turn to. Right now, more and more economists are claiming that 75 points in interest rates hike might be necessary. Right now, any lower rating will be surprisingly positive for the market. So market are expecting at least 50 points in order to have a chance to make a pivot up to a upside. Right now the sentiment is so much bearish that any single positive surprise to the market should give it a chance to revert, at least for a while. Will it happen during the next Fed meeting on Wednesday? We will eventually see. And this bearishness also is spreading out to UK's sentiment. Right now UK faces up to a recession risk. Also consumer gloom is right now at the lowest level seen since at least half a century. So it means that those bearishness haven't been seen since 1950s. So UK economy is forecast to be barely larger in 2 years than it's now. Right now we are heading strictly lower. This slowing of economic growth might be seen in the next even 2 years from now. Also, the longer inflation stays high, the faster the Fed will raise rates, and they will have an impact on the larger headwinds to growth for the companies. US blue chip bond yields are closing in on S&P 500's earnings yield right now. It means we may anticipate a larger downside risk to the economic outlook from falling inflation, adjusted incomes, and faster interest rate hikes. And we are getting to market outlook right now, and we have a forecast prepared by Goldman, and that if recession hits, we may be prone to tumble to 3,150 points. The projections that the newest from this American bank, and 3150 is this level of being previously set by those lows of December 2020. So there was this presidential election lows, and right from the levels where we are right at, there will be minus around 20% from today's metrics. So there is kind of an apocalyptic, I would say, scenario. I don't for now foretell such a bearish case. However, if this very strong trend line get broken, that recently been ongoing throughout since the great global financial crisis was going on, we would see a major sell-off, especially with those trend lines are right now crossing themselves. So the cross of these two diagonal lines, expecting to a major sell-off when it finally get broken, because it by now was defending the price from going lower a couple of times. And as we've been to market outlook right now, getting to crypto. Crypto has gone through massive sell-off recently. The sell-off that resembles to near capitulation scenario. Right now, we don't find that capitulation has commenced, as it was back then, at least in May of 2021. However, this volume are getting bigger and bigger right now, and is leading to some of a extensive drop in the future, possibly. Right now, the price is oscillating between 23,000 and 24,000. That was a previous resistance that right now is becoming a support, and it means that right for now the price of Bitcoin should stay here for longer. Otherwise, this sell-off may just speed up. Right now, we are already after those bad news from the market about the consumer sentiment, also the CPIs, but the Fed rate hike opinion on Wednesday will be quite decisive for the future of the price of Bitcoin. Right now, we are just dropping lower, as well on BTC as on Ether. Ether that right now has crossed through this 1700s levels with a vengeance, and right now is heading lower to around thousands area. It may eventually get stuck here for a while at previous support at 1300s, but there's still far away to claim whether it will be held. Right now, the volume is showing the investors' interest, but it should be confirmed by the market side, and we should have eventually stay here for at least few days in order to verify whether it's good moment to rebound. What I would like to see here is the kind of a big hammer candle that should eventually close right above this 1300s level. Otherwise, there will be a bigger chance that we may see a major capitulation right on the way. With this volume right now being created, I do find there is a chance to stop the price of Ethereum at those levels for a while at least, but as I told in the case of Bitcoin, we need some clarification, some more clarification. Whenever the price drops, many of the observers and analysts are finding out what are the possible problems that may cause possible capitulation of the market. Some of them are claiming that Celsius app is a app for the stakers, crypto stakers that generate some yield, might be a problem as it already has paused a withdrawals. So it may be a kind of a alarm for all of its holders that the problem of liquidity of this app, of this Celsius reserves might be threatened. And other of those alarms might be that Lido, that is a biggest Ether staking service, might have centralization problems. As we've been found, there is a right observation that if one entity gains majority control of the distributed ledger, it could interrupt the recording of new blocks. That's one of the problems. There are 21 validators responsible for Ether staking according to Lido's website, and there might be too few. We need some more in order to have the servers running uninterruptedly. And Lido problem might be also the one that may cause major problems in the nearest future. So these are the kinds of problems we need to observe very carefully in order to take an investment decision on this market. Whether are we already through with this all problems regarding the sector, or any others cockroaches are still on our investment crypto way. And we are heading to market mover section, and as it's Monday, I'd like to take a look into this week broader aspect of economic events, as I'd like to prepare you for this what's coming very next. So on Monday we have very important from Great Britain GDP that right now has turned out to be in a contracting tendency. Right now, we have missed market expectations of a 0.1% expansion. So that's why we may have a serious reason to think that this recession might stay here for longer. So supply chain shortages and also price increases are causing some problems into the economy. Right after, on Tuesday, we have a unemployment rate also from Great Britain that is expected to hike a little to 3.7%. Previous the consensus was at 3.6, so the forecast is overtaking the consensus of economists. The very important for the euro area is the economic sentiment index, but right after the United States sentiment is not expected to turn out very good. The forecast is that it should get eventually better, but I don't expect any fireworks. Right after we have PPI, that also is very important gauge in order to verify we are any chance to have the situation better in terms of producer price inflation. Recently it dropped, but with recent very bad ratings, I do unfortunately expect this to turn it once again to the upside. So market expectations are that we will have seen it much, not maybe much, but higher at 0.2%. That's kind of a probable. The next days I'd like to just show you up a bit in a bit quicker way, as we have retail sales from US Fed interest rate decision on Wednesday at 2 p.m. that it's very important, and the forecast is at 1.5%, but there is a high threat of having it even higher right after previous gauges been published. On Thursday we have Bank of England interest rate decision that's also very interesting. Housing starts and building permits right after, and on Friday some of the Powell speech upcoming. Alright, so that's it from this sector. Right after we are getting to trade idea section. Right now let's have a look at trade idea section, and I have for you a gold spot to US dollar trade proposition once again, and recently on Friday it hasn't succeeded, so we are making another attempt as there is a better spot. We are just going to observe. And right now let's have a look at trade idea section, and for you today I have once again gold spot to US dollar that recently trade position hasn't succeeded, but we have a chance to grab it once again with a different strategy. So gold spot has recently have gone through triple top. Triple top is a formation that is kind of a bearish indicator of a possible future outcome. So after triple top being right here drawn, and also after aligning this top from November of 2021, we may find there is kind of head and shoulders, extended head and shoulders pattern that might be clearing right here. So with this one, I do find that gold would rather not have a chance to get through this peak. Once again, we already seen a local euphoria on CPI data on gold and sell-off coming out of that. However, there might be a trap for now, as we find there is a volume coming in. I wouldn't find there is a short, easy bet right at the exact time I'm recording. And that's with this arrow, I've just appointed a possible way for the gold price to get lower and lower back to lowest 1800s, or even back below that, in order to construct a right shoulder of the head and shoulders pattern that's highly possible right now. All right, so that's it in today's episode. Thank you very much for watching. If you have enjoyed, just hit the like button, and see you next time.